As you can see, we have quite the list of things to go over today. So on this slide here, we're dealing with a defined benefit hybrid plan. This is the main retirement. Most members are going to have this plan. NDPERS is that basically provides a hybrid defined benefit plan that is funded by contributions from the members, employers, and earnings from investments. NDPERS defined benefit plan allows members to compute their future retirement benefits from a mathematical formula set forth basically from the earnings and performance of the fund. The members or the beneficiaries are guaranteed to receive no less than their accrued member account balance. As you can see, to be eligible or mandatory participation, you must be at least 18 years of age. You have to work at least 20 hours a week, 20 or more weeks a year, and the position is a regularly funded and not of a limited duration, not temporary. So, I mean, those are some of the things that we basically you need to be able to participate in the plan. Now, for elected officials of participating counties at their individual option may enroll or waive participations in the defined benefit plan within the first 6 months of their term. All other elected officials who meet the above mandatory participation requirements must be enrolled in a defined benefit plan within the first 6 months of their term. We do get that sometimes from the county, so I wanted to make sure that was brought up. Now, for participation of appointed officials, officials of all other participating employers appointed on or after August 1st of 1999 who meet the above mandatory participations requirements must be enrolled in a defined benefit plan effective within the first month of taking office. Now, for optional participation here, anyone who does not meet the mandatory participation requirements who is 18 years of age has the opportunity to enroll in IndyPERS as a part-time slash temporary employee. The individual must elect to participate within the 6 months of employment or 180 days as a part-time or a temporary employee. If they do not enroll during this window, they will waive the future participation as a part-time temporary employee. If they pass on this, they can't enroll until they become eligible for a full-time position with the employer with IndyPERS. And one of the things you got to remember, though, is that if the member does elect to take the actual, start contributing to the retirement plan as a temporary employee, they are doing it on their own. I mean, they're completely, the contributions will be by the employer or by the employee, and it contributes by a 15.26% of their gross salary on an after-tax basis for that plan. So they just need to be careful when they're doing that, that they realize just how much of their paycheck will be going to those contributions until they reach full-time status in this case. And here we'll show the breakdown of the actual buckets so it's a little bit more obvious. So for tier one and tier two, those first enroll before January 1st, as you can see, the employer sends to IndyPERS 15.26% of the gross earnings each pay period. Remember also, employer authorized agents, overtime is not included. It doesn't happen as much as it used to, but that does tend to be something that we have to keep an eye out once in a while to make sure that overtime is not added in that. As you can see, 7% goes into the employee account balance, as I said before. So when the member goes in there and they're trying to calculate, just remind them that basically it's a combination of their contributions, your contributions as an employer, and then of course compounded interest that's being added there as well. And that's done on a monthly basis each month. As you said before, the employer account is 7.12%. That goes to a general pool of funds that's used for the lifetime benefit for the member once they're eligible, start to have drained out their account balance. And then it also includes investments that's done by the state's investment organization, so the RIO. So, I mean, you can basically can see this, the breakdown. So if you have any of your members ever ask how these investments are basically broken up on there, because a lot of times they're going to be thinking that when they see the 7% in their account balance, that they're not getting enough money to put into their retirement. You got to explain to them that there's portions of the retirement that doesn't go into their account balance, and that there are different areas where the actual funding goes to in this case. So for tier one, tier two, it is breaking up into three different sections. One for the retirement health insurance credit. And you got to remember the thing about the retirement health insurance credit, that's all after tax dollars. So that's one of the reasons why members, when they retire and they're able to use that benefit, and we'll go a little bit more detail on that benefit later on, but that's why that benefit is an after-tax benefit. So it's not taxable. It's not counted as income later. And of course, here's tier three. As you can see, it's basically a good example showing casing that, um, as you can see, there's just no contributions for the retiree health insurance credit, but the member's not eligible. So the members do not have the RHIC for tier three. Okay, we're going to switch over a little bit to one of the other plans that some of the organizations might have, especially with counties and cities, is the defined benefit public safety plan. As you can see, the eligibility and mandatory participation is very similar. In some cases, they have to be at least 18 years of age. In this case, they have to work at least 32 hours a week to be able to receive, be able to have contributions put in there. 20 more weeks a year. The position has to be regularly funded and not of limited duration. This also includes political subs that include firefighters and correctional officers. So definitely, that's something if you have firefighters in your organization and correctional officers, this is not a bad plan for them, and it definitely is something to take in consideration if you do not have it yet. As the main retirement plan, other than the public safety plan tiers did get changed after 2020. So if those who are first enrolled prior to 2019, they have a different tier system than those who are basically enrolled after January of 2020. So as you can see, tier one, the vesting is 36 months. The contributions, 5.5 for employees, 9.81% for the employers, and of course they have the retirement health insurance credit as well. As you can see with the asterisk, contributions may be at 7.93 for agencies without any prior main plan service. So sometimes it's great if you're someone that's basically on here listening to see if you want to come with our plans, sometimes it's a good idea to do both if you have those options right away. Early retirement for the public safety plan is age 50 with 36 months of eligible employment. So at age 50, a person could retire with this plan. As you can see here, we have all the tiers lined out. We have the date first enrolled. Once again, tier one, prior to January 2016. Vesting, 36 months. That's one thing they all have in common. When it comes to vesting, if you have 36 months of contributions, then you are vested. Let's look at the contributions. Tier one, it's a 7% for employee, 7.12% for employer, and 1.14% retirement health insurance credit. Tier two, it's the same contribution rate. And when you get down to tier three, basically very similar, except as you notice, there is no retirement health insurance credit benefit. When it comes to early retirement, you're able to draw retirement at age 55. So for tier one, normal retirement is the rule of 85 or age 65, and they have a 2% multiplier. Age 55 is the earliest you can retire without having met the rule of 85 or age 65. Of course, there's a 6% penalty per year away from 65. Now, let's say we're doing tier two. As you can see, age 55, but it's an 8% reduction. To be able to retire without a penalty, you have to be age 60. And of course, with tier two, they have a 2% multiplier, just like tier one. Now, when it comes to tier three, again, 36 months, no retirement health insurance credit, age 55. They also, like tier two, have that 8% reduction. Now you're looking at that. They're also having to basically, if they want to have no retirement penalties, have to wait till they're age 60 and their years of service meets the rule of 90. So if you're 62 and you meet the rule of 90, you can retire without any penalties. If you're 60, sure. But if you're 57 and you meet the rule already, there will be that 8% reduction per year away. And again, you'll have a 1.75 multiplier. Now, the one thing I want to make clear is the rules. All right. Tier one's got the rule of 85. Tier two, tier three has the rule of 90. The rules are only to allow you to retire before the age of 65 without any penalties. If you hit the age 65, you can retire whenever after that point. You've met normal retirement. It does suffer a 6% reduction if you do not meet the rule of 85 or age 55. Public safety members basically are able to retire at age 55 as long as they have 36 months of eligible employment. So for them, it's not a bad idea sometimes to go with this plan if they can. It does have a 2% multiplier like the main retirement plan for tiers 1 and 2. So I mean, it's comparable in some cases in that case. And then when it's going with tier 2, those who were first enrolled after January 2020, the vesting the same. They'd still have the RHIC, whereas the main retirement plan with those who have tier 3 do not. The public safety plan does have the RHIC benefit. The age of early retirement is still the same. And the rule of 85 and the age of 55 to be able to retire at any normal time is the same also as well. It's just the multiplier is the thing on there is 1.75. So I definitely might want to recommend any of your public safety people who may think about pulling out their balance of their account when they leave. If they may even come back to an organization again, they might be doing it their own at detriment. And we'll get into that a little later. Service credit investing, to basically be vested, as I stated in the other slide, is 36 months typically. So just remember that 1 month of service credit for each month NDPERS receives a contribution on your behalf. So when you have to basically send contributions for your members for each month, that's one more month of credit for them to get reached towards becoming vested. And that's what one of the things that basically those months of service is what helps determine what their pension is eventually. And we'll break down that basically formula, should I say, in this case, of how we determine the pension. Vested, so many people call in to find out what vested means. And vested means you are legally entitled to a monthly benefit. And that basically means is that they're able to receive a monthly benefit for as long as they live. You become vested the earlier of achieving 36 months or 3 years of service or attaining age 65 in this case, while employed. Now, this is the main plan only. Just remember that. But here's the thing. Say a person starts working in your organization and 3 months into it, they turn 65. They're vested. They may only have 4 months or so of service, but they're eligible for a monthly benefit. I think the smallest one I've seen for a pension is about roughly about $7 in that case. So I mean, it is doable in that. I'm not sure someone would want to do that, but nonetheless, they do become vested after they've reached the age of 65. And remember, this is an annuity. You receive a monthly retirement payment for the rest of your life. So if even if they're not quite at vesting, they may not want to actually draw that balance out. And we'll get into that a little later too. But this is a lifetime benefit. You're not going to find too many places that are going to offer that. So please let your members know before they leave to think twice about doing a refund or rollover until they know what their finances are in this case. Grandfathered NDPERS retirement plans. Now, this is if you have a new employee, maybe grandfathered under a previous tier if. Now, as I was talking about early, some people leave employment and they don't work for an organization for a very long time, and then they come back. And then now they're concerned, did they lose their tier 1 of their main retirement or their public safety in this case? Well, if the member left their account balance intact, so they did not take a refund or a rollover, they're still with the tier that they were before they left employment. So if you were with tier 1 with the main retirement plan and you didn't refund or roll over your account balance and you left that alone and you come back 5 years, you're not with the main tier 3 plan, the 2020, or the tier 2 plan, public safety. If you were in law enforcement before and you came back to an employer that has a public safety plan, you're still with the original tier 1 that you were before. So return, and then the second option is return to work for an agency that has the NDPERS defined benefit plan. So I mean, as long as that person meets one of these two criteria, they're going to be with the plan they had before. Dual membership, combined service credit for vesting and normal retirement. Some of our members were with the main retirement plan originally, and then they came on with a different employer, or maybe they had a background to go into public safety as a firefighter or a corrections officer. So what happens here is, if the service credit basically is combined when it comes to figuring out whether or not to become vested. So let's say they have 5 years of main retirement and then they work 15 or 20 years with the public safety. So when we basically calculate what their age is and their years of service, we're going to basically calculate the time that they had with the main retirement, so 5 years, and if they have that 20 years of the public safety, that's 25 years plus their age. And if they meet the rule of 85 with that, meaning that their age and the years of service meet the 85, they can retire normally without any penalties. So it's very important that they basically are aware that sometimes when members are basically switched from one plan to the other, they're automatically thinking, oh, I should have it all in one plan. Well, they don't all necessarily have to do that because here's the thing. If they had 2 years, say, with the main retirement plan and they work 1 year with the public safety, they're already automatically vested in both. So they'll be able to get a monthly payment in the main retirement plan and the public safety. Even though they worked 1 year with the public safety, they've got 2 years with the defined benefit plan, the main retirement. So those 3 years together makes them automatically vested for both plans. And later on, if they continue to work with the public safety or wherever they go with the main retirement plan, once they meet each one of those different plans retirement dates, whether or not it's age 55 or rule of 85 with the public safety, or age 65 or rule of 85 with that, they can retire with either one of those plans. In some cases, with the public safety, they'll retire with that first, and later on, if they meet the criteria for retiring for the main plan, they'll retire with that. In some cases, they'll retire with both at the same time if they basically meet the both criterias. So, I mean, that's definitely something doable. People don't realize it, but for the Teachers Fund for Retirement, those plans also count towards your years of service when it comes to being the vesting, and same with the TIA with the university system. So, I mean, those are things that we basically have to look at, and you as well, to see whether or not a member might meet the rule of 85 or the rule of 90, depending on the circumstances at this point in time. All right. So we talked about how I talked about earlier that we are going to figure out the formula and how that works. Some of you might know this. For those who don't, this is a good thing for illustration of how we determine what the final average the pension. And so what it equates to is the final average salary, or FAS. And what that is that we basically look at the years of service. And I talked about how the years of service for each contribution that basically you as employers would contribute to the member's account becomes 1 month of service. Well, after so many years of service, when they're ready to retire, NDPERS looks at the last 15 years of employment and takes the three highest 12-month consecutive periods of the last 180 months, last 15 years. We times it by the benefit multiplier. So in this case, we're looking at tier one and tier two, and this equates for the main and the public safety. So basically, we look at those last 15 years, we take the best three 12-month periods. And it's not always the last 3 months or 12 months, or the three consecutive 12-month periods, I should say, in this case. Because of people's lives and the jobs they may switch back and forth, there may be a time period earlier in the 15 years that's better. Well, we're going to take the better of those contributions and use those consecutive 12-month periods during that time. So if you've got one good year in the last year of your employment that we can grab, we're going to grab that. But maybe you have 10 years ago, you had 2 years that were fairly significant because of the position you had at that time. So we'll take maybe that last year of your of employment, and we'll take those 2 years, that 10-year period from that, and equate basically your final average salary. And that's basically that final average salary is taken by those three 12-month periods, divided by 36, and that's how we get your final average salary. We times that by 2% and then your years of service. And that basically equates what your single life monthly benefit is. So when people see that single life benefit on their thing, or get that when they leave employment and they get this DB vested notice, that's how we're generating these. We're looking at the final average salary, times it by 2%, and times it by your years of service. Now, the other retirement options are a little different because they are actuarially reduced depending on the circumstances, but we'll get in a little bit on that. Here we deal with tier three for the main and public safety. Again, same final average salary system. We're just looking at the three highest 12-month consecutive periods of the last 15 years. Benefit multiplier, we're looking at 1.75. Years of service, again, same thing. We're looking at the years of service, except of course with this, you can't retire any earlier than age 60 with this. So the slide shows single life as calculation. We do have some other retirement options depending on the circumstances. If you're married, you can do the 50% joint survivor, 100% joint survivor, 10-year term, 20-year term. 50% joint survivor is basically the member is able to select their spouse as a beneficiary who can receive, on the event of the member's death, half of whatever the member is basically earning for a pension at the time. It is actuarially reduced between the age of the member and the spouse. So depending on the age difference between them, it can adjust the actual pension benefits. So it's going to be less than a single life. Same goes with the 100% joint survivor. It's reduced by age, except in this case, the benefit is also reduced a little bit more because one, at this point, if anything happens to the member, the spouse would receive 100% of whatever the member was receiving at that time. It's definitely probably the most flexible plan of the three for a married couple. It is up to the member to make that decision. 10-year, 20-year terms are a little bit different. They're not reduced as significant as the joint survivors, but they're for a limited duration. For the first 10 or 20 years, depending on which one they take, if the member dies during that 10 or 20-year period, the spouse would receive the same benefit as the member was receiving. On the 10th anniversary of the retirement or the 20th year term of the anniversary of the retirement, it ends. It's done for that spouse. If the member outlives the 10-year or 20-year term, they continue to get the same payment that they were eligible for at the time. And once they pass away, the retirement plan is done. Nice thing about the 10-year, 20-year, though, is if there were children listed as contingent beneficiaries, they can receive a split of the pension that's still there if it has not expired in the 10-year or 20-year term certain. So that's kind of nice. Some other options we have there is a partial lump sum option. This one's not done very often, but some people like it because what happens is the member can select this and they can receive one full year of their pension payments all at once. It does actually reduce their pension because one, they received a full year payment all at once, and so we have to adjust that, and their pension does basically lower permanently afterwards. Some people do it for having to pay for a house, travel expenses, medical bills because of certain circumstances. But we don't see that one often, but it does happen more than the other one will do and talk about, and that's the graduated benefit option. This one basically can assist when it comes to inflation, or if a member is young, met the rule of 85, and they're going to retire and they're going to go work for somewhere else, they may want to take this because what happens is we actuarially reduce the actual pension depending on what type of increase they're going to take. So what happens is reduce the pension, and the member can take a 1 or 2% increase each year to increase their pension. So we reduce it, and if they pick a 1% increase each year, it goes up by 1%. Now, it'll take a few years to get to the point where they could have been had they not done the reduction. But once they basically reach that status, that increase continues for the rest of their life. So if they live a long time, they can actually see a larger pension than what they could have received eventually. Um, like I said, I don't see this one happening very often. Uh, and the inflation thing may not be as significant to basically offset inflation, but it's still something to look at, especially if you have a person that's retiring and they're fairly young yet. All right. So you know the formula, but what's that mean to the pension? Well, this here is an example of the main retirement benefit estimate. This is kind of what people, when they call in, they say, well, I'm a benefit estimate. And one of the neat things about this, you don't have to call a retirement counselor to get these. You can call the office, request one. They can submit a form, and basically there's a benefit pay specialist that will set up the actual benefit estimates, and they'll mail them out. Or the member can go online on member self-service, and they can do it all in themselves. They can basically generate instantaneously and receive the same thing that they would otherwise call the Indy PERS and ask for a retirement counselor or a benefit pay specialist. But for an example here, we see a rule of 80 applies. There's no minimum age. So as you can see, it's tier one. The person is married. Their retirement date is March 1st of 2045. That's not that far away when you think about it anymore at this point. The account balance is $68,450.89. The benefit multiplier, as says before, was 2%. The age of retirement, this person has met the rule of 85 because their age is 55. Their years of service is 30 years and 3 months. So I mean, you've got basically someone who's met the rule at age 55. Maybe they're going to take a graduate benefit option at this point. It doesn't look like it, but the final average salary for this person is 3,000. So as you can see from the calculation of the formula, their single life would be $1,815. Okay, and that's life that they pick single life. Now, if they pick 50 or 100% joint survivor benefits, depending on the age difference and the one they select, it can reduce that dollar amount. If you got someone that's within a year of each other, you might only see maybe $50 to $100 decrease for the 50%. The 100% joint survivor might be more significant in that case. And as you can see, the retiree health insurance benefit here, the standard credit is $151.25. We're going to get into more of the retiree health insurance credit a little bit more down the road here. Now, the 50%, 100% joint survivor credit, basically, here's the thing. If a person picks single life and they're not going to give the benefit to a pension to their spouse, they can actually elect to give their spouse the credit at a reduced amount for either half of what they were receiving at the time or even 100% of what they're receiving. So that's only in situations like 10-year or 20-year term or single life that person's not giving a permanent credit to the member. They can act or pension to their spouse. They can give that credit to their spouse, so they at least get that for the rest of their lives. Tier two, this really gets to basically shows an example of the difference between tier one and tier two. So once again, it's pretty close. I mean, you've got the 2% multiplier, but it's age of retirement, 60. That's the earliest this person could have retired. And they have the same years of service. So as you can see, the final average salary is 3,000 as well. It's $68,450.89. The single life benefit is 1,815. So it's no different. The retiree health insurance credit, no different. This person's married as well, so they would receive this. But the thing is they had to work longer to reach that. So that's why making sure that members who are with tier one do not get hasty and refund their accounts, even if it's only a few months or a year, because you just never know when they may come back to an organization or even yours for that matter. So, I mean, it's they're not being hurt too bad on this, but the thing is, there's the age of retirement. They're just going to have to wait a little longer in that case. Now, tier three is where you see a significant difference, and that's going to be the dollar amount that they're going to receive. As you can see, this person has the same requirements or the same years of service in this case as the others, but the benefit multiplier is 1.75. They retire like tier two, they have to retire at age 60. This person's got 30 years again and 3 months, the same final average salary, the same account balance. They're married, but as you can see, the single life benefit, it's $1,588.13. And there is no retiree health insurance credit. So, I mean, it's very imperative if you have members who are thinking about refunding or rolling the accounts because they don't think they'll ever come back to work to the state, they might want to hold off just in case. All right, so keep talking about refunding and rolling over and you know that they're eligible to get a pension. So here we kind of see the account balance and separation of employment. These are the options that a person has. A member can choose to have the member account balance paid directly to them. If a member chooses this option, only 80% of the taxable amount of the member's account balance is payable to the individual because IndyPERS is required to withhold 20% of the payment for federal tax purposes. In addition, if a member is under the age of 59 and a half, the member could be subjected to an additional 10% penalty for early withdrawal. So if a person's not vested, they only have a couple the options of either refunding, rolling over, or they can leave their account balance there. I mean, because if they leave their account balance, even if they're never going to come back to the state, it's not always a bad idea to leave it in there because they are getting interest compounded each monthly. Finally, the lump sum, if they do the lump sum, which they do have the option, it takes 31 days to process that actual refund. And so basically, it basically could be anywhere from 60 and 90 days because we need 31 days to basically accumulate their contributions from you. So when they leave, it's imperative to make sure that you get the last contribution reported to NDPERS. So if the member does want to actually refund their account, they're eligible to. But it just reminds them it can take up to 60 and 90 days because we have to wait for the employer to provide us with the last regular paycheck. So as you authorized agents, it's very important to make sure that when a member's leaving, to get those contributions to us as soon as he can. And understandably, you do probably have a process of doing that, but definitely don't forget about because there's times where we do have members. I can remember one time one school actually did not report the last contribution for a member and it was 7 years later. And they finally got a defined benefit statement, basically letting them know that they had an account balance, and they called in wondering what this was because they'd forgotten about it already by that time because the employer had forgotten to send the last contribution in. So please don't do that. Uh, Now, the other option besides refunding their account, basically, instead of taking a cash out of their account and suffering 20% taxes, and if they're in the state of North Dakota, 3.92%, and the possibility of that 10% penalty if they're under the age of 59 and a half, there's a direct rollover. They basically can roll over their retirement into a traditional IRA. It can basically they can do that. The thing is there will be no taxes done on it. NDPERS will not charge a handling fee. The only thing is the member would need to verify if they're whoever they're rolling it over to will basically have any hidden fees. So that's something to take in consideration. And if they leave employment, they can do a combination of rollover or refund. So they can do a combination of either one if they wanted to in this case. That happens in cases some of your organizations will take care of contributions with after-tax dollars. Those can't be rolled over into account. So therefore, they would have to basically do a refund of the after-tax dollar amount and a rollover of the pre-tax if they wanted. Now, if they're vested, they have one more thing. They basically, if they're vested, they're able to receive the pension payment. So retiring as early as age 55 or age 60, depending if they're hired after February 1st of January 1st of 2016, or have retained or reached the rule of age 65 or one of the rules like 90 or 85 in this case. So they do have these different combinations. So when they leave, don't automatically give them the refund rollover kit, basically, because the thing is, maybe they want it, but they also should take in consideration they should be looking into their account to see what they have in their balance. All right. We've talked a little bit about this, and I've hinted towards it, the retiree health insurance credit. Basically, here you're going to scale rundown of what the credit is. So many people, when they look at this on their benefit estimates, thinking it's like some type of insurance bill or something like that, and that's not the case. Uh, for every year, basically, of service for a member hired or enroll, or basically first hired before January 1st of 2020, there's $5 put aside for the member by you, the organization, to the retiree health insurance credit. If they retire early, it can be reduced, just like the pension. So they definitely, that is something to take in consideration. Now, this credit basically is what happens is when they first receive their pension payments, they can start claiming the retirement health insurance credit. Now, what this does is they get reimbursed for any time they prove that they're paying for a health insurance, prescription drug plan premium. This also works for dental and vision. Now, the one thing I can see is this wasn't edited and everything on that part is your organizations probably uh, do not have dental and vision, but as the retiree, they are eligible to take the dental and vision plans, even though your organizations may not have had those. Most the political subs don't have them, but the thing is when a member retires, they become eligible to take them regardless if they had them before. And another thing is, even though it says also applies towards NDPERS dental and vision, other dental and vision plans will work for this. The only thing that they have to remember is that when it comes to get reimbursements for this, they have to pay for the premiums themselves completely. If there's any assistance with an employer, or if the you as the organization is helping pay down like their COBRA insurance, they can't claim it. It's considered double dipping by the IRS tax code. If you'd like to get some more information, there's a video on IndyPer's YouTube page that goes over the details about the benefit. I would say the person that did the YouTube video did a respectable job. I might be a tad bit biased on that one, though. On the UNDPERS YouTube page, a person can find other videos that we've done about various benefits that members can receive. So I definitely, if you have the option to go on YouTube, we do have some great videos out there. Service purchases, which we'll be getting to a little later. There's one by my colleague, Marcy Aldinger, who's a retirement counselor as well. That's out there. I definitely recommend viewing that. That's a great video to go by and get an idea of how service purchases can affect members in this case. Oh, return to work. Uh, this is always a fun one for members, employers, and retirement counselors in this case. Employees returning to work. Now, this is primarily for employees who have the retirement benefits in this case and are coming back. Now, if they basically refund their account, it's no big deal. But there's circumstances about when they come back to work. If they're early retirees, say they left early before they met the rule of 85 or age 65, to at this time to come back, and they've been on receiving a pension, and they decide to come back full-time employment, they must have their retirement benefits suspended if returning to an eligible position. So if they're coming back to a full-time position and it's something that's basically funded by the state legislature, so that would mean that they'd have to freeze the account, and they need to let us know about that, because if we don't get informed about this and they don't freeze it, NDPERS will have to actually recover that month of payment they have and freeze the retirement and start making sure that you're reporting contributions to NDPERS. So in a way, they're actually building up a second account. Now, when they retire later on, we'll be able to reset them up again in this case. And depending if they're going with two different bank accounts, they can either split the actual retirement accounts to the two different banks, or they can merge them and have them pay the same account. The one thing though is if they come back and they pick like single life, they're still stuck with the retirement options they had before. So they want to be careful about that when they come in. Normal retirement, let's say that basically they've met the age of 65 or a rule of 85 or a rule of 90. If they're coming back and they're working in a temporary position or something of that nature, or they're working a permanent part-time position where they're working less than 20 hours, they can basically waive participation in the retirement plan. There is a form that's part of the new hire kit that you should go out and have them complete and make sure they submit to NDPERS, and they can work. But the thing is if they work any more than 20 hours as a permanent part-time employee by the state century code, they're required to start contributing again, and that will freeze their retirement. Now, if they're working as a temporary position, they can work more than 20 hours. So, I mean, that's definitely something that I would recommend that a member, and even in this case, if you feel uncomfortable about this, contact NDPERS and talk to one of the retirement councils to make sure for the eligibility and waiver to require it to make sure that this can be set up. Please do not take this lightly, because there's been plenty of members who've had their retirements messed up because they came back to work and did not inform the employer didn't inform us, or the member didn't inform us that they were coming back. Now, if let's say the person's terminating a participation, they go from part-time or temporary status. Basically, you need to make sure that if this happens, it's reported in PERS. So if this person comes on and they're working as a temporary employee, you need to make sure that they're reported as a temporary status, or they're a part-time or something of that nature, because one, if you don't, and you accidentally go in there and you put them as contributing, which is going into employer self-service, uh, that's going to really mess everything up, and it's a real pain to fix that. So please be careful that you're terminating their participation. And that goes to whether or not they were going from full-time to basically temporary. They switch over. As soon as they become temporary and they've met the criteria, then they can then retire. But we need to know about this, and it needs to be updated in the system. Also, Remember, members or authorized agents, I'm sorry, I'm so used to talking to members, I'm a little biased on that. Please use the chat to type in any questions. So if you have any questions or whatnot, there's a chat feature on the side. Type in there, and our of my colleagues, my other retirement counselors, my boss Mary Jo will help out with the various questions on that. So now we're going to be going over disability and survivor benefits. I would say that this one is kind of hard sometimes, and it's definitely very important for the employer to assist their members as much as possible. Uh, this one, if given enough time, can definitely help the member out who are dealing with a type of disability, whether it's physical or mental. Um, Sometimes it's just no fault of the member at all in this case. And the thing is it's a limited duration that they can basically enroll in this. So after a member has accumulated 6 months of service credit in Indy PERS, a member is covered under the plan's long-term disability program. To be eligible for Indy PERS disability retirement benefits, the following must apply. The disability must have occurred during the period of eligible employment. So this disability had to be going on while they were employed with their employer that has the Indy PERS retirement. The member must be unable to engage in substantial gainful activity due to a member the terminal physical or mentally impaired, medically I might add, expected to result in death, or which will or has lasted for a continuous period of not less than 12 months. The member must submit a written application for disability retirement benefits to the Indy PERS office within 12 months of termination due to disability. Members that are deemed eligible for Indy PERS disability benefits will receive 25% of their final average salary for each month for as long as they are disabled. This payment will not be reduced by any other benefits they may be receiving as a result of their disability. A member who qualifies for Social Security disability benefits and submits a completed Indy PERS application for disability retirement benefits with a copy of a Social Security notice of award letter will be deemed eligible for Indy PERS disability benefits without requiring a determination from the medical advisor. However, the member will be required to submit an application for recertification of long-term disability benefits with 18 months from the date of receiving the first benefit payment and may be subject to ongoing recertification requirements as specified by the medical advisor. The disability is funded by the employer's contributions. That's another thing to remind your employees if they're thinking about this. Payment of disability benefits does not reduce the member's account balance until the member has reached age 65. So if they're concerned that they won't have anything, especially if someone is unfortunately received terminal illness like cancer, and they're afraid that if they go on disability, that if anything happens to them, they won't be able to provide anything to their family. One thing they can take, one solace they can take is that when they're on this disability, it's not drawing from their account balance. It's drawing from the general pool that the employer contributions go to. So that is something to take in consideration. One reminder, a member can start the process of disability 6 months prior to terminating employment. Too many times members wait till the last minute. If you have an employee who's struggling and probably may meet that criteria, it is better for them to come months in advance to be able to start setting up the disability so that we can start the process, because it can take some time to basically get that all taken care of. Once the forms are in, it's submitted to a medical advisor who reviews to see if the member meets the actual criteria, and that could take up to 45 days. So it's better for a member, especially if you have an employee that is struggling with a type of what you think would meet the criteria, they should try to get in touch with a retirement counselor to start the process of setting that up. Plus, if it ends up that they don't meet the criteria, they can cancel this. They can also, if they decide, they can go on early retirement if they meet that criteria. Now, if they do the early retirement and the disability, if it turns that they do meet the criteria for meeting the disability benefit, we'll switch them from a early retirement to disability, and they won't suffer those early retirement penalties in that case. So it's definitely something to think about. I wish more employers would notify their members who are struggling. I mean, I know it's not always an easy thing to talk to them about, but they have this benefit. And I know a lot of employers will call in to see if there's a short-term disability. We do not have one. And I just want to make that clear. We have the disability for retirement, but we don't have a short-term disability. Survivor benefits. In cases of members dying, this basically assumes that the member is not receiving a retirement benefit. I mean, I know it's possible. We've talked about return to work, that some members could come back with a retirement, but for most of your employees, they're going to be not retired yet. If that happens and basically the person is married and everything in this case, or in the case of single, so they can receive a lump sum payment. That lump sum payment can be like a refund. Basically, 20% will be taken off for federal taxes. And then if they're, in the case, married or non-vested members, single or non-vested members, that basically those lump sum payments can go to whoever their beneficiaries are, regardless of the spouse or their children or who have you. Now, let's say that there is a surviving spouse and the member is vested. Well, they can still take the lump sum payment and do the refund or the rollover, but depending on how long the member has been with the NDPER system, it can be a different type of annuity that they can receive. They can actually receive a death benefit that can receive a monthly payment for as long as they live. In a case of someone who's vested but not met the rule of 85 or age 65 or the rule of 90, depending on the tier you are, the spouse could pick up 50% of normal single life. So whatever their normal single life, they could receive 50% of it. Now, let's say the member has met the rule of 85 or age 65 or public safety at age 55, and the employee passes away. Then they're eligible to receive 100% of the joint survivor type payment in this case. So we do like if it was a 100% joint survivor option, we'd look at what they had met so far, and basically we would do an actuary reduction of the age difference, and then they would receive that dollar amount for the rest of their life. Definitely, if you know that a member has died, it is so important to report it to NDPERS. We have go on employer self-service. There's emails you can send to us, documents. I mean, things that basically help us to start the process because it's really time sensitive to make sure we can get these benefits to the spouse in a timely manner. So it really is something to be looking into once you get taken care of and go through this training. I would recommend going online to NDPERS. We do have an employer resources, and we'll get into that a little later in this presentation. Service purchases. We definitely be going over this. Once again, we're going to go briefly over this. There's, like I said, there's a great video out there by Marcy on our YouTube page for NDPERS. I definitely recommend looking at that and having your members going out there and looking. It's great. I mean, definitely, I think a lot of the people who were lucky enough to see that video have seen the benefit of it. So what does service purchases do? Well, it can help basically get a member vested early. You're basically, depending on the circumstances, buying additional years of service and adding it. You know, most of the time when you have credit, it's basically because they worked and then they get a contribution from their paycheck that's basically reported and sent to NDPERS. Well, by buying years of service or doing a service purchase, they can buy additional months and add it that they didn't work with with you, and they get to get the credit for it. So basically, you're buying time that you didn't work, but you get the credit for it. That's great. It can also increase lifetime benefits. Basically, uh, your pension will increase. So if you've got 20 years and you buy 5 years, that's almost a 10% increase, depending on what your final average salary was at the start of when you bought that time and whatnot. It also increases the retirement health insurance credit. So you buy a year of service, well, that's another additional 5 year, $5, I should say, on your retiree health insurance credit. And it helps them meet whichever rule they're with. And if someone could mute their phone, that would be great, or their computer, that would be great. So now the types of service purchases that we can buy and everything in this case. Well, previous public employment. If you work for the military, you can buy up to 48 months total. If you work for the federal government, you can work as many months as you want, buy, I should say. Legislation, if you were with the legislative, you can actually buy that time. Employment in another state. So if you work for another state, a city in a different state, a county or a school, these all can be purchased. The retirement plan you're purchasing must be liquidated though. So many times we have people who call in and they've got this previous time that they have with the military or with the federal government and they want to buy this time and add it to their retirement. They think they just can purchase that time and then, take maybe a payment out to help pay for that from the retirement account they're in, and they can leave that balance back in there. If you have a retirement plan and you have funds still in that account, it must be liquidated. Now, do you need to liquidate and roll that over or use that to pay for this purchase? No, but you do need to cash it all out or roll it into some other thing that is not part of that retirement plan. There cannot be any funds in the previous retirement plan. Now, some people have drawn out the plan, they've refunded or something of that nature. If that's the case, that's fine. You can still buy the time, but we need to have verification that you have drained the account that you basically are buying the time with, and we will need to submit for that member. In this case, sometimes this happens a lot for counties or cities that basically are joining our organization or were with us but didn't have our retirement plans and now switched to us, and the member is able to buy this time. So they're going to have to be careful about making sure, and yeah, definitely it doesn't hurt for you as an employer to let your member know, hey, if you want to buy this time, definitely contact IndyPers, talk to your retirement counselor, but let them know they're going to probably have to liquidate their original account that they had with you to be able to buy that time to transfer over to IndyPers. Other types of service purchase, of course, previous IndyPers participation. Maybe they worked for your organization, they left and they did decide to refund or rolled over their account. Now they're back and they're realizing, oh, I really should have had that, and they can buy back that time. So, of course, it typically costs about the same as it would with if they're buying other types of service. And basically they have to be reminded though that if, let's say, they were in a lower paying position when they refunded, now they're working for your organization and they're working for a higher pay. It's going to be basically calculated from that higher pay, not from what they actually had earned originally. So that can be kind of a sticker shock when they see that purchase in that case. Unpaid leave of absence. So if they leave for some reason and they can buy an entire month of that, it's a minimum. Let's say for seasonal, you have seasonal employees and they basically work 9 months and there's 3 months they don't. They can buy up to those 3 months and add that to their years of service. So that's kind of a nice feature. Unfortunately, a lot of people don't realize that. So if you have seasonal and they're interested in increasing their benefit, this might be something to do. Generic service. Anyone who's vested, and to be vested again is means having 36 months of contributions. In a lesser case, maybe they met the rule of reach the age of 65 and they want to buy years of service, they can now. So that's just something to remember, that when you become vested, anyone can buy up to 60 months. They can buy 5 years. So definitely that's something to take in consideration. The other thing that they can do is unused sick leave. Unused sick leave is only at the separation from employment. And unlike the other four options that you see above, unused sick leave is calculated a tad bit differently. And we will go into that a little later in this presentation. So the members have 5 different ways that they can invest. That's what this is really is. When a type of when they're doing service purchases, it's allowing them to invest. A lot of members will call in and they want to know how to invest in their retirement, and this is the one way. Because typically, when it comes to the contributions, it's 15.26% for the main retirement. And of course, as you can see, the public safety is a little different in that case. But the thing it comes down to is they can't change the percentage of the contributions when it comes to anything they can do on that part. Now, there is going to be one thing we can do that can add to the account balance, but when it comes to the pension, other than working more years of service, raises, buying time is one of the few ways that they can invest into their retirement and make it better. Showing the impact of the main retirement plan for tiers 1 and 2. The cost to obtain all additional service credit with the exception of sick leave conversion will be determined through actuary cost calculations. The cost calculations will be taken into account your date of birth, years of service, current highest average salary, years of service to be purchased, and age when you're first eligible for unreduced retirement benefits. So there's a few factors in there. And of course, there's also basically the rule of 85 is also taken into consideration that as well, or a rule of 90. So you have quite a few different factors. So I would definitely recommend that once a person becomes vested, if they're able to afford it, it's definitely better to buy it when you're younger than older a lot of times in this case. So in this example, we have the assumption that the cost is 39,000. Okay, so that's been determined by the various different factors on there. So we can see the difference between someone who has purchased time and who hasn't. If you have no purchase, you're looking at 3,000 for a final average salary with a 2% multiplier and 20 years of service. As you can see with single life, it's a pretty straight formula. So the person would receive $1,200 monthly. And their annually they would get about 14,400 and over 20 years, 288,000. That's pretty nice, actually. But now let's look at the person that bought the 60 months who has the same thing. Now it's going to be the same 3,000, 2% multiplier, but it's 25 years service. Now it's $1,500 monthly single life. And the annually it's 18,000 now, and it's 360,000 over 20 years. Apparently, I've not had enough caffeine today. So it's a 72,000 additional income. And as you can see, the calculation down below, following average salary, 2%, years of service, and then the return is approximately 10 years and 10.8 years. So it does take them some time back. So I mean, the thing that when they're buying time, they've got to basically understand, one, nobody can guarantee them the $300 extra each month for the rest of their life like we can. But they have to realize that there is a slight gamble, and that is that it does take some time to get that back. So they're kind of betting against their life expectancy in this case, but it doesn't. It's not a bad idea, especially if, say, in this case, that 39,000 is when they're basically earning a very lower pension, and say 4 or 5 years later, they would actually get an increase in their wage, and their fall average salary goes from 3,000 to 6,000, and they bought that 5 years while it was 39,000. If they had done it when their fall average salary is 6,000, it's going to be double or more that actual cost. And they're not going to get the same benefit perk from that as they would have had they basically bought it when it was much cheaper. And now they're working at a better wage. They're actually getting a better bang for their buck in this case because they bought that years of service while it was a much lower cost. And now that they've gone up in increases over the years, now they're going to have even better. So whereas this person does get a benefit, now, if this person was much younger at the time when they bought it and got that for 39,000, and later on it retired with 5,000 or 6,000 for a final average salary, they're going to get a far better deal than they did at this point in time. So, I mean, that's something to take in consideration. Now, for unused sick leave or converting unused sick leave, basically what that is that when a person retires and they have unused sick leave or hours of unused sick leave still left, they can convert those hours into months of service. One thing you need, if a member asks you this, and a lot of members get this wrong, on average, sick leave for most organizations, nearly 95%, 99% of them are going to be basically the member has to pay for the sick leave. And what that does is they're not burning their sick leave when they leave. We're just looking at those months of service that they could generate from it and allow them to invest in their retirement one last time before they leave employment. If your organization pays out sick leave, they're still going to get that sick leave payment regardless. So a lot of people, when they call us, they think that that conversion of unused sick leave is either they can do the buying of this months of service or they can get their payout of their unused sick leave. That's not the case. It's they can do both. They can have the employer, if your employer basically, so your organization does pay sick leave, they can get their sick leave payment. Now, let's say your organization doesn't pay for unused sick leave when they leave. Then this is a great thing for them to still get something out of that sick leave and use it to basically invest in their retirement. Let's say they paid 60 months, which is the normal maximum for generic service. and they don't have any other previous service that they can buy. Well, this allows them with unused sick leave to buy in addition. There's more time that they can buy. So unused sick leave is a nice investment as a last attempt to invest in their retirement. Now, how we generate unused sick leave is done by the example on here. In this case, this member who's either with tier 1 or tier 2 has 1,450 hours available. We divide that by 173.3 hours and we divide that, and that equates to the months. So in this case, the division would be 8.37 months. One thing to remember, we always round up. So in this case, it's 9 months. That's how many months this person can buy. Even if it'd been 8.01, it'd still be 9 months. Just remember to always round up. Now, as you can see, the difference between doing it and not doing it. The no purchase, 3,000, 2%, 20 years, probably the same person from the last one. And granted, please don't use these for how to figure out your own calculations in that case, but these do kind of give you an idea of how we're basically determining these pensions and these payments. So you're looking at 20 years of service, and then it's still that 1,200 months for a single life. Okay, the person that buys the 9 months, same thing, but now they have 20 years and 9 months of service. Okay, so it's $1,245. Now it doesn't seem like much, but the thing is over time, especially as you can see down below where it says the return approximately is 7.6 years. It basically, we're hoping our members are going to be living more than 7.6 years once they retire. And if they do, and the thing is it doesn't take very long for them to get that time back. And with some of our members being very long lived, that definitely is not a bad thing to be doing. It's not for everyone. If they don't have the finances, we don't want to bankrupt them in that case. But if they are interested, it's definitely not a bad thing to invest in their retirement. As you can see here, we actually calculate what the cost is, unlike generic service or previous public service or military or federal. It's not a bunch of different factors. All it is we look at the person's final average salary, we times it by how many months that they're able to buy from sick leave, and we times it by 15.26%, and it equates to $4,120.20. In most cases, buying 9 months of sick leave in this case would be cheaper than buying generic service. Not all the time, but that's something that members should be advised and definitely should bring up when they basically are getting ready for retirement. When they talk to their retirement counselor, that's something you might want to remind them is look into sick leave. And they're going to need your assistance with that because one of the forms that basically starts a process, if they're going to roll over with pre-tax dollars or something of that nature, they're going to need your assistance. So service purchase payment methods, as I was saying before about that form, we have a conversion of unused sick leave form that's part of the retirement kit that we have on our NDPERS website. So if you go into retired members and there is an area there where it talks about retirement kits and forms, one of the forms on there is basically there to basically help them either decide if they want to do a rollover, and they could do a rollover from a traditional IRA, or if you have a deferred comp or a 403B that you have with your organization, they can roll that over to pay a vast majority of that dollar amount. In the case of this member that has the $4,120.20, they could pretty much close to almost 95% of it roll over to pay for that dollar amount. If they're with tier 1 and tier 2, they'd still have to pay a portion of it for the retirement health insurance credit. Because, as you probably will know, employers basically contribute after tax dollars for retirement health insurance credit. So when they're buying this time, there's a portion of that purchase that has to help pay for the retirement health insurance credit. So members who have tier 1 and tier 2 have to use after tax dollars from their checking account or savings account to pay for the portion of that purchase. So in that case, of that $4,120 some dollars, that person would have to pay about 5% of that in after-tax dollars to make that happen. And that conversion form that you can get on the retirement form packet basically gives you an option to do rollovers. And they can basically roll over that portion. And then the employers have to actually help with doing the last 3 months of gross income the member has received and basically signing off on it. Now, if the member decides to pay all of the contributions with after-tax dollars, then they basically send that form to NDPERS and the employer does not need to worry about that. Now, for generic service or previous public or whatnot, it's kind of the same as the sick leave. In this case, there's going to be rollover forms, and there's going to be a form to set up for the purchase or payment of the after-tax dollars. The members can basically, once again, roll over from various different traditional IRAs, 457 plans, 403Bs. If they do not have enough money to pay for it, we can do payroll deductions. If now, granted, it's if the employer allows it too. So definitely make sure you let if the employee calls and wants you to know, make sure you can verify whether or not you have a pre or post tax agreement with your contract with Indy Purse. Not all employers have that, so it's very important for the member to get in touch with you on that. And then payment plans. There are going to be interest applies to them, but we can set up payment plans for the member to basically pay into that. So they don't always have to go through the payroll deductions, but it's definitely an easy option for them if your employer allows it. Okay, we're going to be moving on to deferred comp. Deferred compensation is a voluntary supplementary retirement plan eligible for employees of participating government agencies. So, as I said before, it's voluntary. Members can enroll in it at any time as long as your organization has this degree to basically offer that benefit. And basically, the nice thing about it is they can invest pre-tax dollars, which lowers their actual taxable income. So it's besides being a great way of putting a nest egg, also in addition to having their pension plan that they have with you through us, they can also put money aside so that when they retire, they have other pools of funds to draw from. And if they're earning, say, a fairly large salary, they can actually use that to help reduce their taxes that they have to basically pay at the end of the year. So it's definitely a nice thing to do. Just remind them that when they do get to distribute the funds, and remember, when it comes to deferred comp, they're not able to pull that out whenever they feel like it. They can do rollovers for purchase payments, in cases of extreme emergencies, they can actually uh, take out payments for a case of an emergency. Now, the thing is, with those, they actually have to go to a review with the board, and there's paperwork that's required for them to complete to verify the nature of their emergency. And they're going to have to list all their funds and bills and the reasonings of why they meet that criteria. So it isn't something to take lightly, and I definitely don't recommend doing it on a regular basis, saying, just take it as an emergency fund. No, it's very time consuming, and it isn't guaranteed that they're going to even receive that. Now, when they leave employment, they're more than willing to be able to grab that. It takes about 31 days. So when they leave employment after they receive their last regular paycheck, they can take contributions out. But definitely while they're employed, they cannot take those funds out. And remember, the employer determines that the plan is available for their agency. So if you haven't, maybe you talk to your employer or to your board to see if they're interested in adding that. Definitely remind your members if they do, if your organization already does offer it, that to take advantage of it. It's definitely a great benefit. Now, typically, members can basically contribute up to $25 as a minimum. Uh, Granted, if you're doing like a semi-monthly, basically it'd be like 12.5, $12.50 and stuff of that nature. For the maximum right now for contributions, the IRS annual limit it has increased from 2022. It's now 20,500 per year, or 100% of taxable compensation. For those who now reach the age of 50 or more, the limit for 2022 is now 27,000, so it has increased. Regular 3-year catch up, you definitely, if someone wants to be involved in this, they need to do it within 3 years prior to the year which you retire. So make sure that about 5 years or so before that, if someone wants to do this, they start getting the process ready, and they can basically invest up 41,000 in this case. If there are additional forms required, then they will have to get in touch with IndyPERS to receive those. Now, some employers have their own 457 plans, and the employers are responsible for tracking the annual limits. So if you guys have your own 457 plan or a 403B or something of that nature, it's not IndyPERS. And please remind members that if they have that, that they need to come to you for those if it's ours, because there's some organizations that have both. And sometimes it's kind of sad that when the member calls in and they're going, well, my employer told me about this one here, and I can help them with ours. I don't know about the other your organization. They need to talk to you about that. Now, some of the things that they can do when they basically have employment is they can contributions, I should say. I'm getting a little ahead of myself in this case, but if they're going to basically contribute to the actual contributions to the deferred comp, they do have some options. They have lump sum payments. So when they're leaving, basically they would complete a SFN 3803 form. It's the deferred application for deferred comp, and it makes for changes enrollments in this case. So this form, more or less, it allows them to do unused annual leave can be rolled in there when they leave, unused sick leave, and back pay. So it's kind of nice in that case that if they're leaving employment and they don't want to be taxed on it, they can roll that into their deferred comp. Now, granted, they still have to worry about the subjected, cannot exceed the annual IRS limits. So if it's over the say if they're 50 years and they already got that 27,000, they're not going to be able to put more than that in there if they're already close to that limit. It is subject to FICA before the deferral. So definitely remember that FICA is still involved, and severance pay and buyout distributions are not eligible. So if there's a severance pay, that's not eligible to go be rolled into the deferred comp. Portability Enhancement Provision, or PEP. This is probably one of the most misunderstood plans out there. The DB plan and the eligible deferred compensation plans work together. So if a person has a defined benefit plan, the main retirement, they're eligible to, as soon as they basically start doing the deferred comp, they're able to get PEP. So if they're putting contributions in a deferred comp account, they're getting PEP. And now, depending on how long they've been with the organization and how much they're contributing to it, they can actually use that to basically increase their main retirement account. Does not increase their pension. What it does is it redistributes the funds. And I'll get to show you an example that kind of breaks down how that redistribution of funds happens. It helps increases the members' growth of their account, and it makes it more portable. What we mean portable means is that, let's say you're working for an organization, you have a member that's working for your organization, and you and that member know that they're not planning on staying with IndyPERS or your organization for very long. They can do PEP by enrolling in a 457 plan, and they can make sure that more of the funds that are going to the retirement is going into their account balance instead of the general pool of funds that the employer contributes to, and they're able to take more money with them if they decide to refund their account or roll it over after they leave, meaning that they're not planning on staying with IndyPERS' retirement plan. So we're going to show that how it affects for tier 1 and tier 2 because of this. All right. So as you can see, we kind of have, once again, those three buckets that show the different types of investments. So you have this 7% for the employee account balance, and you have the 7.2% for the employer account. And of course, with tier 1 and tier 2, you still have contributions going into the retirement health insurance credit. Now, if you have 0 to 12 months, so basically you've been started working and you're within that 0 to 12-month period, 1% of your gross pay or the minimum of $25 is basic, and you're investing that in your deferred comp, means that what's going to happen is that the employer is going to basically look at what the employee is contributing to the deferred comp, and they're going to make adjustments. Now, in this case, if the person's doing at least $25 and they basically are within that 0 to 12-month period, the maximum amount they can basically have changed is 1%. So if they're contributing 25 or even $1,000, they're only going to adjust 1% how all these contributions are done. So as you can see, now instead of that 7% going into the employee account, 1% of the contributions that each month that the employer would be contributing for an employee's or member's retirement is now going into the employee's account. So that's 8%. It's more going in there than the employer account now instead of the other way around. The employer's account, that general pool that everybody draws from when they retire, has now been reduced to 6.112%. And of course, the retiree health insurance credit is not affected at all by this. So that's what's going on here. The member is now receiving more funds than the actual pool of funds used for retirement. So now if they decide to retire, they're still getting the same pension, but there's still more money in their account balance. Some people will say, well, I plan on retiring with Indy PERS. Why would I do this? Well, there's always in situations like if something would gravely happen to you and you're not around, your family will have more funds to draw from if you've not met retirement yet. So as you can see, once they get to within the 13 to 24-month period, and now they're able to contribute up to 2% of basically 2% of the contributions that normally would be reported to their retirement, because now they're basically eligible to have 2% of it. Now, granted, to have that 2%, they need to adjust their earnings and their deferred comp so that they're making sure they're at least getting 2% of their retirement or their paycheck is being contributed to the deferred comp. Now, 2% of those contributions is being added to the employee account. Now it's 9%, and the employer account balance is 5.12%. So now you have a very large portion of the actual contributions going into the member's account. So just basically it's padding the account, making sure that the member has most of the money and not the pool of money used for retirement. Now, if they get to 25 to 36, it's at 10%. And finally, at 37 months, when they finally get past the 36 months that are vested, they're at the maximum amount of 11%, and the employer account balance is 3.12. So as you can see, if they basically after 3 years and they want to leave, they're now taking more money with them than they would have had they not done deferred comp. And so that's what PEP is. It's just a redistribution of the person's funds going more so into their account balance than to a general pool that they don't have access unless they retire. So when PIP people call in or if the people ask about that, PIP is basically redistributing the actual funds to their retirement so they can take more money when they leave. It doesn't increase their pension. So that's why they're doing PIP. They're not helping themselves in that case. But they are basically making sure that there's more money in their account. If they decide they don't want to stay with the IndyPER system, they can take that money with them more so than they would. Now, how does it affect tier three? Well, as you can see with tier three, there is no RHIC. It's 7% an employee, 8.26% for the employer account balance. And as you can see, the first 12 months, once again, 8% is going to the employee account balance. 13, 24, 9. I mean, so eventually, as you can see, it's slowly building up so that it is more to the member in this case. And the thing is that with no retirement health insurance credit, I mean, the PEP really helps the member who's tier three be able to make a determination if they want to stay with the IndyPERS retirement or refund or roll it over into a different account once they leave. As I said before, when a person enrolls on the deferred compensation plan, the PEP is automatic. A lot of people always ask, well, how do I know my PEP's going on? Well, if you've enrolled into deferred comp and you actually have a monthly amount being deducted each month, it's going on. And if you're not at the maximum, consider increasing your contributions. I mean, because the thing is, if you want to get the 2%, you got to be at least at 2% of your paycheck going in there. If you want the 3%, you've got to get to at least the 3%. So, I mean, if you're just doing $25, you're getting the most minimum amount, 1%. So definitely after, 2 or 3 years, you want to adjust that what you're actually compensating in there. Plus also it means that you're putting more money aside for you to be able to pull from the deferred comp at that time. So the thing is a lot of people think, and I dislike this when employers, so please as authorized agents and someone asks you this, please don't say match. It's not a match. The money is not magically generated or created. What's going on, as I said before, you're just taking money that you would normally contribute to the employer plan, and now you're shifting some of it into the member's retirement account. And that's really all that's going on here. So, and if you have someone that's not enrolled with deferred or your organization doesn't, please contact a representative with NDPERS. If the member if you do have the plan and a member doesn't have it, they've decided to go with one of the other different types of providers that we have TIA as our main, but we do have Bravera, Nationwide, the Bank of North Dakota, just some of the others we have. Some of those do require them to talk to an agent or a representative to be able to enroll. Also, some of your 457 plans that you have of your own or 403B plans can qualify for PEP, especially if they set up with us when you're set up your contract. So that's definitely something to double check in to make sure to see if your organization has that set up already. Now we're getting to online employer services. Now, what we're dealing with here is um, when you're trying to find information for something that pertains to your members or something that you have to do for your organization, for contributions, for reporting to the federal government about the insurances that you might have with us. And we'll get into insurance later as we go in this presentation. You really need to go out to here to find the information. If you don't have the answers or if you've got a question about this is where you're going to go for the employer resources. IndyPERS has everything online there for you to look over to verify what you need to do. A lot of times employers will call and they'll ask a retirement counselor. We don't usually go over this. So I'm going to more likely basically direct you to this website to go to find what you need to basically process this. So you go to the www.ndpers.nd.gov, and that's where you're going to go to find our website. Once you're on our website, there is a white banner where it says employers, and you basically click on that, and you're going to get an option, employer resources, and then there's, of course, join NDPERS plans. Well, we're dealing with employer resources, so you click on that. And then you're going to see this options. You're going to see the processing for payroll, the employer self-service. So that's the training material for basically if you need information how to basically navigate employer self-service, which is definitely a system online system that you can go on and add people in the system. Make sure you take care of contributions. There's definitely a nice training a lot of material out there to figure out how to use that system because trust me, you really need to be on employer self-service to make sure that you update things. It's also best reporting practices are listed in these material. Employer and payment models with examples. So if you've got to figure out what your payment plan model is, we have examples out there for you. How to upload file templates, where we even go over reporting deaths. And as a retirement counselor, us retirement counselors handle the deaths. And so sometimes if we do have some systems in place to try to keep track of our members if they pass away, but if you know if a member that used to work for your organization passed away, please contact NDPERS and follow the process that's done listed on the employer resources because we definitely need to have that information taken care of in there. And then of course PeopleSoft benefits administrations. I mean, we have all that on there. And like I said, just it's easy, it's in a fairly readable thing. I've gone out there occasionally myself sometimes to look over it because we do get questions. And like I said, I have to go out to there because it's not something that's in my training. I highly recommend you going out there and reading it. Administrating the Indy PERS plan. We have an employer guide out there that goes over the basically how to use our plan with your organization. We have the employer-based wellness, which is a nice benefit for those who are willing to that organizations that are enrolled with that benefit to help their members get some perks for exercising, eating healthy, all kinds of neat little things you can do to basically give your employees incentive to take better care of themselves. Also, we have some extensive information about the Affordable Care Act. So, I mean, if you've got questions, that's the place to go for that a lot of times over because thankfully they don't expect me as a retirement counselor to have that memorized because it's a very large thing. But nonetheless, we have guidelines for how your Affordable Care Act affects your organization, how to report for the federal government, some of the things going on with your insurances, the financial reporting. I don't know how many times when I was a member rep, I was a person that used to randomly answer the phones. We would get the GASB, and the Government Accounting Standard Board, and we do have that information on there. And so I would point them towards the member service, the IndyPERS website, because that on there does have the information for it. And then, of course, we have the financial accounting report. So, I mean, these are things that we have out there for you to basically, if you need that information, it's there. And so please definitely do not be afraid to go out there. And then also publications. We have memos, webinars, employer newsletters that you all can go out on there and grab. So I mean, I highly recommend going to that website. Okay, and then if also we have the employer form. So your employer payment election forms are on there. You click on the forms on there. I definitely think that if I do this again, I want to make sure I show that on the web page. Definitely a mistake on my part. The authorization for electronic payments, the memo of understandings for temporary employee waivers, maintaining documentation for 6 years. These are all out there on that, and it definitely is something that if you're looking for them, they're on our website, and there's a little probably blue tab there where it says forms. Please click on that, and you're going to find these forms. The appointments for authorized agents. Say your organization hires a new authorized agent. Maybe you are the new authorized agent. This is where you would find the appointment of authorized agent to be able to make you able to work with IndyPERS, to be able to process the payments and contributions and the insurance plans that we provide to your employees. Meeting requests. So let's say you want to have a retirement counselor come to your organization. Well, we don't do live and in-person things typically much anymore unless it's local. But let's say you'd like a online meeting or a training session for your employees. So basically, there's a form out there that you can complete, send it off to us. My colleague Lori will definitely help make sure that happens. And we'll do it online, or if you're local, we'll even come in person, and we'll go over the various benefits. We can do, like in this case, we're doing kind of a hodgepodge of all the benefits, but let's say you just want retirement. We'll come and give you a more detailed conversation about retirement pertaining to your members if you submit that form. So definitely something to think about. Okay, employer guide and wage reporting. Now, this is once again, you can go out to there and reported wages, including the member's monthly and gross base earnings. So when you're completing these wage reports, either on employer self-service or PeopleSoft or whatever way that your organization typically reports these wages to this, remember it has to be the member's monthly gross base earnings, because it's a pain once we have accidental overtime or lump sum payments, or sometimes accidentally we get transportation expenses in there. And it's frustrating because one, and I know mistakes happen because we're all human, trust me on that. But when you're setting up a person's retirement, and then when we have the benefit determination specialists that audit these, and they try to make sure they're very good about making sure that there's any oddities about these payments. But if we somehow miss that and you missed it, and later on we find out we overpaid someone, we're going to have to get that money back. And we don't like doing that any better than the person that's having the money taken back from. So remember, lump sum payouts, overtime, transportation expenses, housing and wage differential allowances are not eligible for this. So make sure that when you're reporting these gross incomes, they're not including any of these. Performance longevity bonuses may be reportable to IndyPERS, but only if annualized. Um, it does come up once in a while, depending on, emergency situations like COVID or something like that. There could be bonuses, or basically if someone has worked there a long time, depending on the organization, perhaps you provide longevity bonuses to them for staying. It's kind of an incentive for being there longer. If they're annualized, they can be reported. If they're just a month or so, no, sorry, those will not count. All right, special employment arranges. Make sure that if you're doing a full-time contract or written agreement with a member, say like a coach, if you're a school or something like that, he's also a teacher, which, you report all the wages within the contract. Exclude duties outside the contract, incidental. And then we're going to have an example here, thankfully, for this. And exclude overtime. Once again, doesn't matter if it's a written agreement, you still can't include overtime. So an example, Deb works as a school administrative staff and works contracted 25 hours a week. She also assists as a basketball coach and under a separate contract for 10 hours a week. The reportable wages, full-time contracted wages, wages earned on 25 hours a week. So I mean that's what you would basically think. Because the other one's only for 10 hours a week. It does not meet the criteria for the state century code. So basically, we'd be looking at that, what she's working as a school administrative staff. So it's very careful on that. Special employment arrangements, no contract, written agreements. An employee works in several capacities. Some of ours meets the eligibility guidelines. Once again, exclude overtime. Employee works in several different positions, maybe uh, janitor or custodian, I should say. I'm sorry, that's a really bad usage of words there. Custodian or a food preparation person, and they do all this within 24 hours each week, and it's part of that agreement, the written that agreement you have. Well, what is reportable? The sum of all wages. So if they're working both these wages and they're working up to anywhere from 20 to maybe even 60 hours, and remember, we could basically use the sum of all those wages, but we do not include overtime in that. So please be careful about that. Special employment arrangements continued for seasonal, less than 12-month employees. Example one, bus drivers working for 9 months and receive payments for hours worked over a 9-month period. Reportable wages, wages for each month for 9 months, excluding overtime. So basically, if they're not working during the summer, you basically enter a leave of absence in an employer self-service. Please make sure you have that in there because it's definitely can really throw off the actual years of service. It does a disservice to the member too. Second example, bus driver works for 9 months and chooses to have payment over a 12-month period. Reportable wages, wages for each month for the 12-month period. Lump sum payments reported in May not allowed. Must report wages over an entire 12-month period earned. Once again, excluding overtime. So, I mean, depending on how you do your seasonal, you need to be careful about how you're reporting those wages. So, if it's a person that works nines and choose to have payment over a 12-month period, the wages for each month for the 12-month period must be reported in this case. They get a lump sum payment reported in May, it's just not going to be included. Notice of employment changes. It's important to update PersLink online. That employer self-service is so important in this case. Employees leave of absence. Classifications change with the agency. So they go from permanent to temporary. We need to know that because that can really mess up their retirement. And it can affect whether or not they get even their insurance benefits in this case, depending on the circumstances. Reduction in hours. If they're going from full-time to part-time, it can affect what they're actually getting for contributions, how their retirement is affected, and whether or not they can actually even retire eventually. In this case, contributing to non-contributing. So that's so important because let's say you have them contributing and they go to a non-contributing position, and it's temporary, and they're eligible for retirement. Now they can retire and still work with your organization in this case. So that's definitely something that needs to be updated so that they can do. Because if you forget to put that non-contributing, the person says, my employer is going to switch me to a non-contributing status, and they don't, and then we see that, we're going to get an alert, and we're going to freeze their retirement. And that has happened in the past where an employer has, it was a school out by the eastern part of the state where basically they forgot to put non-contributing, and we had to freeze the person's retirement, and then we had to fix that. So make sure for when you're allocating funds as well that they're correctly done. Double check things. I know it's easy to accidentally hit that number if you're inputting it manually or if you're writing it in your books and then transferring it, but make sure everything is correct and explain any missing wages. Because if there's wages missing, we need to know why. If there's contribution missing, it can throw off someone's retirement. So it's a nice thing that we have the benefit determination specialists that we have. We have Shauna and Mary Glauser who help make sure, and they're here not to hound you. They're here to make sure the member's retirement is correct and to make sure that when we set this up, we're not hurting the member. And that's what we're here for, is to make sure that your organization's helping the member and our organization's helping the member. Okay. The important kits on the homepage. I talked about the cyclic conversion form out there. Where do you find these at? Well, if you go to the home page, we have here the various places where you can find them. On the first page of our website, as you can see highlighted on there, enroll or change for my ND PERS plans. So let's say they want to enroll in an insurance plan because it's annual enrollment, or they're just getting hired on. They would go to that area to enroll or change my ND PERS plans. There they can find the newer and higher kit or forms so that they basically can enroll in the forms they need to get on their plans. If it's disability, we click on disability, and there's where you'll find the disability retirement kit and forms. A lot of people call in and they say they can't find them, but they're right there. You just need to click on the various things. And granted, you know, you're there and you take some time when you have a free moment and go on the web page and kind of tinker around with it. I mean, I'll have to admit we have had a couple changes in the past with the website. Last year it did change, so you may not be as familiar with it. When a person leaves employment, make sure they get a deferred retirement kit. So when they're leaving employment, if their balance is under $1,000, they're going to automatically get a refund. And maybe they plan on going back to work for someone, or maybe they are going to be in the next 2 months going to work for another organization, or they're coming back to your organization. And if their balance is under $1,000, and if you've not updated the status for them or provide them a deferred retirement packet that makes sure that they've got the deferred retirement form, they could have their account refunded. And when that happens, they lose their years of service. It's quite significant. And if they somehow had been, some reason had been with the rule of 85 and they left your employment and they were had under a balance of, it seems odd, but it's always possible. The rule of 85 and that refunds out and they don't know. And years later they come back and they're like, why am I with the main 2020 plan now? It's because they didn't send in a deferred retirement form. That application is very important for them to do. They can get it off of the deferred retirement packet. So anyone who's not retiring that's leaving employment, make sure that they look at those options and you provide them with a deferred retirement packet form. Now, it's once again, as I was saying before, what if they're coming back or they're going to a different organization within a month? Well, then you would need to make sure you get a notice of transfer. So there you would look at leaving employment, and there you would find that actual packet on the leaving employment section. Make sure also, I know a lot of you might be told by some of your older colleagues with your organizations or those who have more years with the organization, and they print out forms and have these huge amounts of forms there so that when people ask them, well, where's this form? They just give them to them. Please don't. 6 months in advance. About every 6 months, we update our forms. Okay, not all the time, but for the most part, we do. And after a while, those forms will be outdated. So if you give outdated forms and us retirement counselors don't catch it, or the member completes all these forms without asking anybody else for assistance and they submit them, they will be returned. They will not be accepted and they will be sent out new forms and they'll have to do them all over again. And in cases like that, it could end up pushing their retirement off. It could prevent them from getting certain purchases taken care of. So please, I know it's nice to have those papers handy, and I know that's how they used to, it's kind of how things used to be done. Please do not print forms out. I mean, if you want a small collection of forms, maybe, after we do an update in either in July, or we used to do an update in January, maybe do a couple at a time, but don't have them sitting there for more than 6 months. If they're over 6 months old, please shred them. It's just not worth it. All right, the new hire kit. One of the most important forms that you're going to be working with is SFN 2561. Okay. And enter employee status and job classification online. Confirm accuracy of employee data. So it's very important to make sure that when you're doing this, you do it right the first time. Make sure you put in there whether or not the employee is mandatory and optional participant. So basically, if they're a temporary, they're working enough hours to be able to contribute. You want to make sure that this is the time you get this in. I know some might want to wait a month or two, but remember, they only have a 6-month opportunity. If they get past that 6 months, They're going to have to wait until they become a permanent position, or I should say a full-time position, to be able to do this. So once again, make sure that you give them, or if you feel that they still have some questions, have them give us a call on that. But remember, if they're basically temporary and they're going to be contributing, they're doing it on their own. It's 15.26%, and that's all after-tax dollars. And then remember that by getting this in, it provides basically the ND PERS member, newly hired member, ND PERS ID number, which they're going to need to be able to create their online enrollment. So the sooner you can get this in, the sooner the member can get an ID number, and sooner they can enroll online to basically, if they want to do the enrollment for their insurance benefits that might be eligible. So it's very important to make sure you get those out. Late applications means delayed enrollment and benefits. And they can get rather irate while your members on that. And so definitely, I know you guys are going to have, and gals are going to be busy with your new job, but it's so important to make sure that your employees get this information out to us. The retirement kit. Probably the most important form out there is basically SFN 2562. This one sets up the pension. It's got to be completed in the same month that the employee is leaving employment. If it's, let's say, if a member is, depending on how your organization does the contributions, but if they're leaving, say, the first 2 weeks of January, and you're basically putting the contributions in that month, they need to make sure that they have that form in before they leave that month, because if their retirement's going to be February 1st, we have to have it in there before that. Late applications will delay retirement benefits. Retirees may also lose certain benefits, like being able to buy their unused sick leave. So if they don't get their information in before the last business day of the month that they're leaving in, one, they'll lose their chance to do sick leave conversion. They may not get to use their RHIC benefit right away until a much delayed period. So when someone's thinking about retiring, make sure 2 to 3 months before they're retiring that they call into Indy PERS to set up an appointment, so that if they want assistance, we can help them with it. If you, as an employer, want to help the members with those forms, have questions, you can always call us, set up a time where we can talk with the member and you at the same time if you like. We can do team conferences with you in this case, especially if you want to better understand, because I know this has been a very broad, but there's more minutia to this than we've been able to provide so far yet. The employer should confirm the following for the employee also. When you have an employee that's leaving employment, you need to make sure that you let them know when their last paycheck date, the last month of reported contributions to the ND PERS, the sick leave balance, and the last date of health insurance coverage. Those are so necessary for us to be able to retire. And unfortunately, as much as you'd love that members would pay attention to this, sometimes they just don't. So they're going to need that information. So if you know a member is retiring, please provide that. That is so important for us to be able to make sure that they get retired in a timely manner. Disability retirement kit. Now, when this is involved, and you would still use the 2562 if they're going to be doing early retirement. The form for disability is 18000. And this is only done if the employee, if you feel it's employee eligible, or if the member feels he's eligible, is incurred disability while actively employed. Applications received within 12 months of date of termination. Must be completed the same month that the employee is leaving employment or earlier. Just remember, I said earlier that they could do 6 months in advance. Late applications can delay disability benefits because it takes us 45 days to confirm whether or not they can go on disability. Retiring may also lose benefits if you do late. They may lose out again on the unused sick leave, or they're not able to use their RHIC as soon. And again, last paycheck, last month of reported contributions to ND PERS, sick leave balance, and the last date of health insurance. You need to confirm that for those members. It's so important, especially with disability. Once again, we're going to go with the deferred retirement kit as before. If you have a member that's leaving, if you think that member has a balance, or you know that member has a balance less than 1,000, it's going to automatically refund. So definitely make sure you give the deferred retirement kit, especially if they want to keep that balance in. Even if they don't want to go back to an organization with Indie PERS and they want to continue that interest that's being compounded each month, that is so important. All right. And then, less than 3 years, why refund that if that person can later on go and work with someone within a few months, become vested, and now they get a monthly payment for the rest of their life once they meet the criteria for retirement. So that deferred retirement kit is on our website. The form is SFN 58044. That form basically allows them to defer their retirement and leaves it there until one, the date they want to draw it. If they start when they meet when the date comes that they basically want to retire, we'll send out a reminder. Or if they say it to a date later to be determined, we'll notify them when they meet whichever rule of 85, rule of 90, or normal retirement at age 65. We'll notify them. We'll send out a letter basically saying, "Hey, you're getting close to your retirement age." So one of the big things that we also happens when someone leaves is that they may not be leaving employment with IndyPRIS at all completely. They may be switching over to another employer. Now, if this employee is transferring within 31 days to another employer that has Indy PERS retirement plan, you need to make sure they get the notice of transfer kit. You need to make sure that the SFN 53706 is done in case of situations when it comes to they can transfer their benefits over. So let's say they're basically going from a school to your organization that's a county, and you have insurance benefits the same as that person, or maybe they're different contracts. Well, we need to have this form set up so that we know what they have before, so that we can try to continuously add to their benefits. So if they have our retirement and you have our retirement, we can make sure that those are being contributed to and there's no gap in their coverage when it comes to retirement and maybe their insurance. So the thing is, though, is that it takes you and the employee to be conversing, because when you're doing these notice of transfers, you as the former employer and the new employer need to assist that member to complete the forms. So hopefully have some good conversation. If a member's leaving and they just haven't told you anything, you might want to ask them saying, "Hey, if you're going to another organization, we've got to do the notice of transfer kit." And as a new employer, if you're getting someone and they don't mention it, please ask them, "Are you within 31 days? We're formally with another Indy PERS employer," because you need to make sure that the transfer kits are taken care of. Now, if you're the new employer and your organization does not accept an employee's sick leave and the balance in part or full, the employee can bank this ND PERS with ND PERS and purchase it when they leave employment. Now, the sad part is, in this case, the member doesn't get all, or part only gets some, or in this case, or not at any of their sick leave. So they can't use it for going when they are sick and take that time to get paid. But they can at least use those hours to buy additional months of service at a sometimes reduced amount compared to generic service. The forms are required and they need to be within 60 days. So as you can see, this is what we're looking at when it comes to the two forms out there. There's the transfer of unused sick leave verification. That's form 53404. It's part of the notice of transfer kit that you can get on our webpage. And so, as you can see here, that we have it clearly listed that it's 60 days from the date of leave, employment with the former employer, and that the former employer there has, the member has with the former employer 880 hours and a half hour, and basically the new employer is only going to take, you know, uh, 80 hours. Well, that 800 and a half hours now are going to be gone. Well, the person can bank that time by putting it on there. They sign and date it. And basically, the employer who's saying that they're not going to sign and take it, they're going to basically sign off on it. And the former employer that was offering the 880 hours and a half is going to have to sign and date it. But this all has to be done within 60 days. So it's very important. So if the member wants to buy that time later on, they can. Just remember though, that 800 and a half hours cannot be used for anything else because the new employer has rejected it. And again, over on the right-hand side, you can see how the member would, with the 53706 form, would basically show, the hours that they're eligible, but also more importantly in this case, what plans they had and whether or not those will transfer over. So if they had the group life insurance of, on there, you can't really read it. I'm afraid that's a little small even for me with my reading glasses. You show that they had the basic life and then they had supplemental and dependent coverage. Well, the employer there says yes, selected, and the new employer shows which one of those benefits will continue on. And that does need to be signed by the current authorized agent of the old organization and the new. So as you can see, at times you are going to have to, as authorized agents, talk with the members, get the information about what's going on with a leave, and contacting the new employer in this case. So yeah, you definitely have a lot of information, and that's why to learn, and that's why going on to that employer resource is very important. If we were going to go over everything that's on the website, we'd be going at probably a 4 or 5 day seminar on that case, and I think you would get tired of my voice after a while, and I don't want to have that happen. Okay, the refund rollover kit. In this case, must terminate employment and be off all covered payroll for at least 31 days. So basically, if someone decides they do want to refund or roll over, that's basically they need to be off at least 31 days. So the process takes about 60 to 90 days, depending on when they left employment. So if they think that they're leaving and they're going to get that money back right away, they're not, because if they ask you, well, why does any person have to do this? Well, yeah, they could call us, but you can also tell them that we're not going to refund or roll over the account until we have all the contributions from the last regular paycheck. And that could take time depending on how your organization reports your contributions. Must have bona fide separation of employment. There is no indication you're going to return. So if someone's transferring to, say, from a school to a county, and there's 31 days of a gap in there, they can't do it. Or even if it's 60 days or 90 days, I mean, by that time we're going to know that, oh look, they're working for this new organization that has our retirement. That's going to cancel the refund or rollover. So please let them know if they're thinking about pulling it out. If they're going to work for another organization and they don't tell you anything, at least tell them to call us so we can talk to them and explain that to them. Employees returning to work with NDPERS employers within 60 days, like I said, are not eligible. And if they do refund or roll over their retirement, they forfeit their years of service. If they're Rule of 85, they come back. Now they're with the main 2020 plan. Or if they're the public safety, they're going to be with the Tier 2 plan. Their pension is not going to be as the same calculation. Instead of 2% multiplier, it's 1.75. They forfeit their disability benefits. So if they leave and they're going to refund their account because they need money for bills, and then they turn around and want to do the disability retirement, that's lost. And also, they forfeit the retiree health insurance credit. As you can see with health insurance, we're going to go over the health insurance that we do provide to your organizations. All right. For eligibility, basically, we're looking at a permanent employee and has to work at least 20 hours per week for 20 or more weeks per year, is at least 18 years of age, holds a position that is regularly funded and not of limited duration in this case. So definitely the health benefit for the most part is going to be for people who are permanent people in this case. There are options for eligibility with temporary employees. Once again, it's all about if whether or not the position is not regularly funded, must be at least 18 years of age, must meet the ACA definition of full-time employee in this case, work at least 30 hours per week or 130 hours in a month. Once again, I stated earlier in the previous presentation that I would highly recommend going to the NDPERS employer resources to verify whether or not a temporary employee meets the criteria for the federal government with the Affordable Care Act. It's so important to go out there because there's quite a few different things. I would love to go over it in detail, but I think we'd be here for a while. That would be a presentation in its own right, but nonetheless, the information you need's out there. You can definitely call into IndyPERS and talk with the benefit enrollment specialist, but I would highly recommend you are better off doing this because there's a lot to know, and a lot of times our BS are helping out with many different things besides answering questions. So that's definitely your place to go. ACA requirements. So, affordability. Coverage must be affordable for employees to meet the ACA full-time employee definition. Cannot require employees to pay more than 9.5% of the household income towards single premium. So once again, the coverage has to be affordable. You can't pay more than the employee cannot pay more than 9.5% for the household income towards a single premium. Applies to both permanent employees and temporary employees, meeting the ACA full-time employee definition. So make sure that when you're about to give this type of insurance benefit, that you're going out there making sure that it meets the criteria by the federal government. And again, it's all out on that web page. So definitely go out there. Please make sure you verify that. And again, ND PERS requirements. Permanent employees do not meet ACA full-time that do not meet it are basically working 20 hours per week. Employer must pay at least 50% of single premium. So affordability. These are just continuations on there. Permanent employees that do not meet the ACA full-time definition working 20 to 29 hours per week, the employer must pay at least 50% of single premium. So that's definitely something about having permanent employees with that type of hours as you to see whether or not it's worthwhile to continue to having this employee on that so they get that benefit. There's these things about, once again, whether this person is a good resource for you. So be careful. You want to make sure you want to provide them the benefits, but you've got to make certain that you're meeting the different requirements to be able to do that. Dependents, when it comes to figuring out what a dependent is. I know when I first started working, when my wife went on the insurance plan, which I'm also on, and she said I was a dependent. I'm like, well, I'm not dependent upon you. But what that means is dependents are dependent on the person that has the insurance. So that would include spouse, children. And children can be on the plan up until the first month following their 26th birthday. So if they turn 26 on April 1st, they're not kicked off on the month of April. They have the coverage all the way through April. It's on May 1st that then in this case, they would no longer have this insurance coverage in that. Spouses would remain on there as long as they're married, of course. Now, one thing to remember that if someone gets a divorce, as soon as that divorce is finalized, they need to be off the following month. So the divorce is finalized in June, they need to be done in July. And that needs to be reported to ND PERS. When it comes to children, we'll basically there's guardianship for grandchildren. If there is proof of guardianship or foster kids or whatnot, if you have the government, or I shouldn't say government, court document showing that you are the official guardian, that's another way that you can bring children onto your insurance coverage. Enrollment. Enrollment happens 31 days periods for new hires. Coverage effective first month following the hire date. So if you know you have someone that's being hired on, like, say, uh, May 30th, and there's still one more day before the next month happens, you need to get the stuff in. You need to get them enrolled so that the employee can come on, because if you don't, then they're going to have to wait the following 31 more days. You don't want them to hold off on that coverage. So make sure that's definitely guaranteed that they are enrolling as soon as they can. You don't have to do paper forms. The member, if you've got everything set up and they have their member ID number, they can enroll on member self-service and go online and do that. I wish more employers would basically get their members to go online and enroll that way. It saves on paper trail, timeliness. Granted, you gotta make sure that they're, being careful, take their time on it, because you don't want to mess things up. But the thing is that it does speed up the process. We get things on a more timely manner. There are times and situations where maybe the form might happen if we need to make a correction or something like that might be handier. But or depending on the disability or something of that nature. But the thing is that it's definitely member self-service is I would recommend a probably more expedient way of getting them enrolled. Unfortunately, temporary employees, they're the exception to the rule. They definitely need, they can't get on with member self-service. They must complete paper applications. Annual enrollment, permanent employees, coverage effective January 1st. Please remind your employees. I can't stress it enough that that the 3-week period starting mid-October typically is when it starts, and they need to get in. Um, they can do it through member self-service or paper applications. There are times where paper applications for like life insurance or flex comp benefits, which that might be easier to do in that case. But the thing is that definitely remind them that's coming up, because if they forget to do it and they don't renew or don't continue something, or they'll miss out on that, it doesn't go into effect on January 1. So it's so important to make sure that they're aware of that by mid-October, the third week, they're probably, and we'll send out flyers and we send out emails and whatnot of notifications that's coming up. But it's so important to make sure that they take advantage of that, because once that period's up, there really isn't too much you can do. We can do a few late applications, but after the first week, you're really probably going to be missing out on that chance. ACA annual enrollment temporary employees. Now that's a different time period. That's the second to third week period in November. There needs to be a measurement period to review the employees, determine if any meet the ACA full-time employee definition and need to be offered coverage. So when you're getting close to that time period, I would say definitely within a month or two before that, please review how long that employee has been working, if they meet the criteria, that they basically are being able to be offered that. Because if you don't, it's not going to be pretty. And secondly, you're really letting the member down. And it's so important because uh, insurance nowadays, you just can't go without that coverage if you can help it on that. The coverage is effective January 1st. So unlike a new hire with full time, it doesn't go in the next month. It's like with annual enrollment, it's always effective January 1st. And as with hiring a new temporary employee, they have to do the forms. They cannot do member self service. In this case, same, must complete the application forms during annual enrollment. They can't use member self service. Levels of coverage. When it comes to our health insurance, we provide what's called the PPO basic or PPO provider organization, which is PPO, and the basic level of coverage. Typically, we hope that members are going to select organizations, clinics, doctors that are in network. If they're in network, we're looking at a better level of coverage. They're going to have to pay less for that. Whereas if they do basic level of coverage, which means that it's a provider that's not in our network, that's not part of our plan, or they go out of state. There are some clinics that are in Minnesota. We do have that listed on our website. Some in South Dakota and whatnot that do have our coverage, but you definitely want to look on there because most places out of state are not going to be in network. So if they go to a clinic that is out of network, they're going to end up paying a different percentage and they're going to still receive the same level of coverage. It's just going to cost them more. So when people ask what's better, you want to do the preferred provider organization, the PPO. That means that they are the preferred organization that is in our network. The employer guide available on the website basically gives the general information on the plans and forms. So if you have any questions about how the contract works for you, the insurance plans, what you need to do to make sure that the member gets the information they need or to enroll them on that. Once again, just go to our website where it says employer resources. We have it all out there. I mean, there's times where we have employers that are so frustrated 'cause they can't seem to want to know where the information, because they just go to the general information on the front of our page. Well, that's the basic. The employer guide has what you need to find, and it's definitely in there, and I highly recommend going over it. Health insurance forms, you can go on to the active insurance section on our website, and there'll be a blue tab there where you click forms. The new hire kit basically goes over explaining what the health insurance plans are. So if the members got questions, direct them to there. They can go out there. I would highly recommend not probably printing it out. If they want to, they can. But we're talking about maybe something that's almost 60 pages. It just isn't very prudent on that. If they can go online, I highly recommend them reading that. To be able to enroll, they need to make sure that they're doing the health insurance application or change form. It's form number 60036. Definitely, you can enroll the person in the insurance. It also takes care of temporary employees. You can add the dependents, remove dependents with it. For an active employee, when it comes to health insurance, everything you want and more to add or remove or change your level of coverage, it's there. That's the utility form for health insurance, and it's the one for enrolling in it. If the person's not does not want the insurance plans and has a reasoning why they're going to decline it, then they can do the acknowledgement of or decline offer health insurance coverage, and it's SFN 60711. It's part of the new hire kit or packet forms. So definitely that is one that they're going to want to do if they decide to elect to disenroll. Now, remember, if they do that, the only time they can come on is if there's a qualifying event or they do annual enrollment. And as this before, in annual enrollment, they're not coming on until the first of the month. So if they suddenly had canceled this and then waited till the October period that they're basically able to enroll, and they enroll, it doesn't start November. It's January 1. Transfer forms, once again, to make sure that if you have the same contract that with the health insurance as another organization, our member wants to continue that, they need to make sure they do the notice transfer forms. Otherwise, they may make the mistake of doing a new hire. And then that's going to mess everything up where they didn't need to do that form, because if they would have just done the notice transfer form 53706, if there is the same type of contract for the health insurance, then they could continue it seamless. If there's a difference where uh, see someone has me on with their thing, please turn your computer on mute. I really don't enjoy the sound of my own voice. Sorry, I know that may seem strange, but I don't. Um, the notice of transfer basically would say your organization has a lesser contract, whereas maybe you only offer single coverage, and the new employer offers family coverage. Well, that's a big deal. And with that transfer form, it makes them eligible to come on that plan and able to get their family on in an easier format. It's a smoother process. So anytime an employee is leaving, I know you don't want to be prying if they don't say something, but just ask them, because you're doing them a favor. Termination forms. Okay, so when it comes to leaving insurance, they don't use the 60036, the health insurance application or change form. They're going to be using a different form, and that is the SFN 14120. That's the continuation of group insurance coverage, COBRA. The member can use that to either do single coverage or continue family coverage. And if, let's say, they have a spouse and the spouse and the member want to separate their insurance coverages, then they would both do that form and can do single coverages in this case. Again, the COBRA coverage is going to be exactly like our health insurance. So if their coverage that they had with you is going to continue exactly as is. Now remember, if you don't have our health insurance, you don't use our form. I get that call a lot, actually. And remember, as before, if you're on COBRA coverage, you still use the same network as you were using when you were an active employee. Special enrollment periods. This is the qualifying events. These have to be done within 31 days. So as a new hire, the next month everything goes in effect if we get everything done in a timely. So but if you say a special event like which we call qualifying events like marriage. So if you get married on the 18th, you need to make sure that of December, you need 31 days from that date to make sure you have it in before that. So you want to make sure if you know you're getting married that date, you get married, you need to make sure if you want to add your spouse or any stepchildren that you now have uh, included in your family. I was going to say inherited, but that's not quite the right term, but you would be able to add those children on as long as you get the form SFN 60036 form in time, and you can add them. When it comes to birth, you have a child or adopt or legal guardianship, 31 days. So if the child's born, and I know that for some of our female members, that can be sometimes a stressful situation, especially physically and emotionally exhausting. Some of you, it's no big deal, but still, please make sure you get that form. And I know that's probably the last thing that you're thinking about when you have that bundle of joy, but or adoption. But please get that in a timely manner. Um, Also, loss of coverage. Well, let's say your spouse was on their own coverage and they lose that coverage because they left employment or their job got laid off or something of that nature. That loss of coverage from that date, 31 days, they can get enrolled on the plan. Once again, you're going to use that SFN 60036. You're going to basically need a certificate of coverage or a letter of cancellation from the insurance provider to make sure that they can enroll on our plan. And they need that all within 31 days. Effective date is the first month following change. So basically, the birth is the effective first, is the exception to the effective, exception effective first of the month the child is born. So typically, if you're going to lose coverage and you need that coverage, say you lose your insurance coverage on the 21st on that part with, or I should say, your spouse does on the 21st of March. Well, then it's April 1st is the effective date on there because you're going to want to use the first month that they no longer have insurance coverage and you're having them come on. Well, but a birth is different. So if the birth is the 3rd of February, well, the effective date is the 3rd and it goes to the first date of the month. So it's not March 1st, it's February 1st. So unlike any other of the qualifying events, birth is the first month that the child is born. Please be careful on that one so you're not shorting yourself. And again, you can use the SFN 60036. In cases of birth, I think that the paper form is a little bit more flexible, but in some of these other cases like marriage, loss of coverage, going on member cell service is more than efficient and definitely more expedient. The problem with member cell service, if you don't have the copy of the social security number for the child, you won't be able to enter that in after you complete enrolling the child in there. So let's say you add the child in there, you have the child on the insurance, but later on, when you finally get the social security number, you can't enter that. You'd have to get that to ND PERS by providing a copy of it to us or having your employer provide a copy of us. So in those cases, many times over, since the paper application can be done a little later and brought in, um, or you can make adjustments. You can submit the paper application to update the information. On member self-service, it's a little bit less flexible when it comes to births in that case. But for marriages, loss of coverage, that stuff, it works just fine. Form supporting documentation is I kind of mentioned before about the letter loss of coverage, certificate of credible coverage, or loss of cancellation letter. But when it comes to like births, you definitely want to add in a birth certificate to us. We're going to need a grandchild eligibility verification form if it's adding a grandchild. There are stipulations about grandchildren that too on that matter, and definitely you'd want to tell your employees to contact NDPERS to verify on that. Again, the benefit enrollment specialist can help with that. So yeah, now adoption, we are going to need a copy of the adoption and placement papers. They are basically, we're going to need those in a timely manner. Remember, everything like this is 31 days. So please make sure that you're on the ball on this with your members. Let them know that they need to have this in. They can't lollygag on this because we don't want to be mean, but they don't meet the criteria. If they don't get it in time, we're not going to allow the child to come on. We have federal guidelines that we have to follow too on this. This isn't just about being sticklers for timing and everything on that part. Legal guardianship, we're going to need a copy of the legal guardianship papers. Return from USERA military leave, we are going to need those DD 214s. And again, as I said before, loss of coverage from the insurance provider. Employer-based wellness programs. If you're an organization that has signed up on this or is thinking about it or on that, definitely go on the employer resources to take a consideration of what this does. You will need to appoint a wellness coordinator. The wellness coordinator will attend summer coordination workshops, and they will be effectively need to distribute communication materials to agency employees on a monthly basis. So if you got someone that's really into fitness or really is excited about this, that's definitely a person that you might want to suggest being the the coordinator. And they also have to be some creativity. They develop and submit wellness programs, and so they can get a discount on the benefit program on this case. You can find more information on our website. If you really are desperate, you can always contact Lindsay, who's our supervisor for the insurance plans, implementing the wellness program during the plan year. It's typically the wellness program is from July 1st through June 30th the following year. So I mean, so you're looking at those basically the time period to implement these wellness programs. So what do you get from the wellness program? Well, you get total of 5 points needed. Communication. So you get these points that basically can use to get credits to basically use for purchases, gift cards, and you got to keep track of that. But for total points needed, communication, materials, and wellness workshop attendance, 1 point required. So you need 5 points to be able to maintain this. 1 day program equals 1 point. Multi-day programs, 2 points. The comprehensive wellness plan in its entirety equals 4 points. So these are some of the things that allow these members to have these perks, like they get the gift cards and whatnot. So if you want to be able to maintain these things, this is what you need to do. ACA minimum contributing contributions testing. Again, we're kind of working with the Affordable Care here. The annual mailing from carriers each fall to all political subdivisions on the grandfathered plan. All employers must complete and return to carrier. So we need to have this paperwork to make sure that the minimum contributions are going on. It ensures ACA compliance for the plan to remain grandfathered. So if you wish to remain on the grandfathered plan, employers cannot charge the employees 5% or more of a premiums compared to the percentage of the premium the employer was paying as of March 23rd of 2010. So, I mean, we need to make sure you are following the guidelines on that. Again, I'd recommend heavily going on the employer resources to verify that you are basically making sure that you're not charging the employees 5% or more compared to the premium the employee was basically paying on March 23rd. And they're timely. They need to be done as soon as you can get them. We do affordable care minimum contribution testing, eligibility information needed, number of full-time employees on payroll. You definitely need to keep track of that. Numbers of employees eligible for health insurance. As you know, depending on temporaries or whatnot and permanents, those can fluctuate. And depending on how long they've been with you as a temporary, they could eventually end up being on the temporary ACA requirements. Less number covered under spouse coverage, other employer group it's coverage. So there's things you need to subtract from that when you're basically doing it. So number from the underwriting requirement for your group. So I mean, you've got some of these things that you need to check into. And again, you're probably gonna get tired of this, beating a dead horse maybe, but you need to go on that website and look over it. It's so important because you can call in, but you have all the information you require on that website. And there's going to be things that sometimes we forget because it's a lot of information. So going out there, refreshing your memory, it's such a handy resource. And again, watch out for that March 23rd, 2010 contribution, amount slash percentage paid by the employer and the employee for single and family coverage. That's one it's got to be careful with. And current contributions, what's basically being paid by the employer for single and family coverage. So you've got to look at the March 23rd, 2010 and compare it to that current contributions to make sure that you're basically meeting the criteria. Now, again, we're going still with more requirements. There's a lot on here. If you meet the requirements, participation in grandfather plan can continue, which hopefully is good for your organization. But if you do not meet the requirements, we will notify you with your options of other coverage. Small employers will lose eligibility to participate in NDPERS health plans. And as you might know, as new authorized agents or as authorized agents who've been with your organizations for some time, you know where you stand when it comes to how large your size is. So this can have huge ramifications. Large employers will lose the grandfather plan and will be moved to NDPERS non-father grandfather step plan. And that can be kind of interesting on that part when it comes to cost. There's some benefits to that, but the thing is that you want to make sure if you want to remain on the grandfather that you're keeping track of that. Because, like I said, for small employers, it's huge. It is a significant loss. All right. After going through the ACA on that, let's uh, go to the IndyPERS life insurance. We are still with Voya Financial. They have gone through multiple different name changes in the last couple of years, but Voya has stuck for a while. So we're going to continue on with this. So who's eligible? Well, an employee with at least 18 years of age, work at least 20 hours a week, 20 or more weeks a year, and the position is regularly funded and not of limited duration. Who can be on this as basically a beneficiary? Well, the spouse can, the children can. The children can only be on until after the first month following their 26th birthday. So very similar to what we were explaining about health insurance. And the thing is that when we're talking about these coverages, this is not about them getting them being basically getting payments or something like that for. It's more so that or I shouldn't say that. It's basically for them to be eligible for the member to receive payments. So if the spouse or the children pass away, the member is eligible to receive a benefit depending on what they've selected, and they will get a payment for that. Now, if any of the children should pass away after the age of 26, the life insurance does not qualify in that case. So, I mean, that's something to take in consideration now. Temporary employees may be eligible at their own expense. And again, you're going to want to go out to that affordable care, go out to the employer resource page just to verify on some of those temporary employees. Now, there are 3 levels of life insurance that we provide for these people in this case. The employee life insurance is number one. That is the primary life insurance that we have out there. Right now, if I remember right, it's 400,000 is the maximum that they can receive on a uh, for their for them in this case. And to be able to receive that, there's basic level of coverage, which is at 7,000, but they can basically boost up their life insurance up to a maximum of 400,000. Now, they can do increments of that in annual enrollments. They get a free 25,000 raise, which does not require them to submit documentation to show how their health or on that to see if they are eligible to be able to increase. So that's kind of nice. When they get first hired, they can basically, as long as they're enroll up to the 200,000, they can actually have that up to that point without any actual submitting forms about their health. Once they hit that part, though, anything afterwards is basically they're going to have to send a document out showing whether or not they have any health issues that might prevent them from increasing their life insurance. Their spouse at the time can do half of what they're receiving. If it's under 100,000, they basically get 50,000 on there. So basically, as long as they do up to 50,000, they do not need to submit documentation to show that their wife has any health issues, and then they can do supplemental for spouse. And that dependent life one there, you see a second, includes the spouse and the children. A lot of people forget that when their children are past the age of 26, that dependent life is still required to have the spouse actually covered by this life insurance. And as you can see up here, I got jumped a little gun on there, but we have the basic amount. That 7,000 though is paid by you, the employers, not the member. Now, this is while they're currently employed, of course. The supplementary employee coverage up to 200,000 maximum guarantee. So once again, they can do up to that. Anything after that, basically they have to start showing that they have evidence of insurability, that's called the form, and they have to submit that to us, and we send it to Voya. And then basically Voya will review that. Sometimes they are going to have to do a physical. So just remind them if they're going to be going over 200,000 that they may be required to get a physical. So I know some members grumble about that, but it is required. And then again, I guess with the additional supplemental coverage, the employee can go up to that 400,000 part. Coverage options as dependent with spouse and children. You have basic coverage, which you can do 2,000. My apologies on the dependent. 5,000, 7,000, or 10,000. The nice thing about dependent information is that evidence of insurability does not require during annual enrollment. So that's nice. At least that one you do not have to send a form or have them get a physical or anything on that. Now, spouse supplemental, spouse only, up to 50% of the employee supplemental. So you could have a spouse up to 200,000, but they would have to do an EOI required on all enrollment increases. So it's only at the beginning that when you get hired, that they can do up to 50,000, that there's no EOI required. But anything after that, even if it's when you're doing annual enrollment, it's still required. Life insurance forms. When it comes to the new hire kit, there is a form packet, the life insurance enrollment slash change. That's form 53803. That's where a person can enroll on that. Uh, and here's another thing, you can enroll on member self service for the life insurance. So if you don't want to do that form, that's another great way. But when it comes to the life insurance designation of beneficiaries, yeah, that's still form only. You can't do beneficiaries with online yet. We're going to change that eventually, but for now, you can enroll, you can update your coverages, but at this point in time, you're going to be doing forms for the beneficiaries and evidence of insurability. That's on our on the life insurance. It's part of the new hire kit. The EOI is only done if in the case of less than 50,000 with the spouse. If you're doing more than the free 25,000 increase, they can do your annual enrollment. Or if you do anything over 200,000, automatically the EOI is always going to be have to be applied. Again, some employers have the life insurance. So you want to make sure that the notice of transfer form 53706 that you check off on it to make sure that it can be continued if the new employer will take it. If you're with an employer that doesn't have it and now has it, you want to make sure that's aware so that you can get yourself enrolled on it right away. The terminating employee receives a packet from Voya. Okay, in the cases that you had life insurance and your employer does not have the plan, you will get a packet within about 15 days after leaving employment. You will get a packet from Voya, which will have conversion tables for you to continue the life insurance if you wish. And they will have on there what the dollar amounts will be for your level of coverage. The prices probably were not going to be the same as the one that you had with your employer. Typically, it's more, but not always. It just depends on the age, I guess, on that. And you need to go over the conversion options that they submit to you. ND Burrs does not assist with this. This is completely you working with Voya at this point.